Hi, my name is Kevin Moen, and I'm the president of Root Energy Homes. I'm here to talk to you a little bit about non-traditional investments and how you can invest in income. So why are you here? Well, in the next 15 minutes, we will learn how the banking system is destroying your wealth and what you can do about it, about investment trends in the post-2008 market shifts and the new housing economy, and how to earn passive income with turnkey rentals and note investing. We're actually just going to focus on notes today. If you're interested in turnkey rentals, you can follow up with us at a different time. Now, we take compliance very seriously, so please read through this disclaimer, as we are not offering any securities and are simply offering education right now. We will be able to follow up with you later. Please read through this so you understand what we're offering. So we're going to start with a very quick history on banking, traditional investment option review, what is a note and why notes, who is Root Energy Homes, and how does it all work. A quick banking history. As said best by the founder of the House of Rothschild, let me issue and control a nation's money, and I care not who writes the laws. America became independent in 1776 on July 4th. A little while later, the Federal Reserve Act came into effect under Woodrow Wilson in 1913. We then later went off the gold standard in 71 under Richard Nixon, which led to today's debt-based currency. Our banking system is what's called fractional reserve banking. What that means is when a deposit is made, the bank only needs to keep a small percentage of that on reserve. As you can see in the illustration in front of us, by using 10% of the deposit as reserves and reissuing those funds in investments and loans, just 3 steps down the line, they take 100 units, which you can think of as dollars, and turn it into 171 units. More realistically, those are millions and billions of dollars. Now, ever since we went off the gold standard, our currency is simply debt. This chart shows us the exponential growth of debt since that changed. Pretty scary how much spending power is taken out of our pockets by the inflation caused by this debt-based system. And a last key point is understanding there is nothing federal about the Federal Reserve. The Fed, as I'll refer to them from here out, loans money to our government with interest. They've never been audited, they're owned by private stockholders, and they get the currency from the mint, then resell it to the United States government for major profits. As recorded in the Congressional Record, June 10, 1932, the Fed is not a government institution. They are private credit monopolies which prey upon the people of the United States for the benefit of themselves and their foreign swindlers. That was quoted in 32, and you'd be surprised how true that holds today. And speaking of profits, the Fed profited $82 billion last year. We believe strongly in financial responsibility, and that starts with lending. We lend in a very ethical, informed, and intelligent way, and we help improve communities by putting people in their home or modifying loans to keep them there. According to Benjamin Franklin, we began planning the Revolutionary War in order to issue our own money again. That's exactly what Root Energy Homes is doing today and helping you to do as well. We remove the bank. For comparison's sake, let's take a look at some traditional investment options. First, we've got bonds, as well as savings account, which are paying next to nothing. Then you've got stocks, which can be relatively high risk, a lack of control, and the earnings will vary. Stocks can be a great place to make a good return, especially if you know what you're doing and you're active every day in the industry. However, for the average investor, there is a very little amount of control, and if there's a crash, you can lose everything. We also have IRAs, which technically aren't investments, but investment vehicles, and we'll tell you how you can use those to make money with our program. Same thing with a 401k. Lastly, real estate. Just like stocks, real estate is very much based on supply and demand, but one of the key differences, if there's a crash, you keep your asset, and if you invest correctly, still will cash flow. More on that later. The stock market is entering an all-time high, which means the burst is not too far to follow. Not only are bonds paying next to nothing, investors are pulling their money out of the bond market at record rates. The chart in front of us shows cash flow in, where below the line is out of the bond market. The latter trend is money is being pulled and siphoned out of the bond market, which will not lead to increased rates anytime soon. Now, with all of this money flowing away from stocks and bonds, we're finding that a lot of it is sitting in IRAs. That's not a terrible thing, but that money is not growing. We'll show you how you can use funds out of your IRA or 401k to invest in real estate secured income. So what is a note? As far as our business is concerned, a note is a deed of trust or a mortgage. The state the property is located in will determine which one. There's also a promissory note, which spells out how much and when and what term the note is to be repaid. A note, simply stated, is an IOU. Even a dollar bill is a note, especially since we're no longer backed by gold and it's just legal tender. So we buy notes at a discount. What that means is if a property is worth $100,000, we might be paying something around $60,000 for that note. That gives us $40,000 of protective equity. In case a borrower defaults, we have the right to foreclose. That's a last case resort, but that protective equity ensures that we'll get our money back. The borrower pays our licensed servicer, who then deposits the funds directly in our account. We don't need to know the different laws in different states, crazy accounting, or anything like that. That is all handled through a third party who's our licensed servicer. So why notes? Firstly, the inventory is extreme. This chart in front of us, the lighter colored, more tan bars are non-performing loans, or NPLs. As you can see, those tower over the caramel color, which is REOs, and the short sales, which are almost not even visible because they're so small, at the bottom of those charts. The inventory is huge compared to REOs and short sales, which are traditional discounted real estate. Between 2008 and 2013, only 4.5 million REOs and short sales were sold. So where's the real opportunity at? Well, there are 10 million delinquent mortgages in America. The last few years have shown a very clear shift from REOs to notes. Fannie Mae even for the first time came out and directly sold a pool of notes to investors. What we're seeing is banking institutions realize it is far more profitable and far more efficient to sell a big roll of assets and the paper itself than it is to foreclose on the property and try to resell one at a time or in batches. The real opportunity for the average investor lies in investing in notes secured by properties in the Midwest and Southern United States. The reason for that is affordability. The average property value in those areas is $40,000 to $60,000, which can be hard to believe if you live in the West Coast in California or Seattle. Those properties also rent for $500 to $850 a month, which makes their cash flow incredible compared to other areas with much higher property values. We invest in those areas so we can leverage our funds and get the most affordable investments at the best return. So why notes? High inventory, low competition, and affordability. So who is Root Energy Homes? Our mission is to create affordable, sustainable American communities by providing efficient, beautiful homes while creating an exceptional customer experience and promoting financial responsibility. We sell income secured by real estate. There are two sides to our business: turnkey rental properties, and then what we're talking about today, which are performing loan sales, making you the bank. We sell income secured by real estate. Performing loans. How does it work? We are in the business of purchasing and originating performing notes. We sell a fixed number of payments to an end investor, who could be you, for an agreed upon rate of return. We keep the back portion of the loan, giving us a vested interest in the deal. Well, what does that mean? Well, that means you would own the front end of these payments. You would get paid in full by the borrower or from your servicer who will be collecting the payments on your behalf and making sure you're compliant within the law. Let's say that you buy 180 loan payments out of 300. You'd get the first 180 payments, and once those are paid in full, that's where that shift happens to where we would be the ones receiving the back end payments. That means that Root Energy Homes is very vested in that deal being strong and successful so that we get paid in the end after you've been paid in full, getting your entire principal and all interest returned back to you. With these investments, there's no tenants, no toilets, and no late night phone calls. When's the last time you called your bank to come and clear your clog? You are the bank, not a landlord. So from start to finish, this is what it looks like. It all starts with you, the investor. You schedule a one-on-one consultation with us so we can better get to know your needs and help match the right deals to your goals. We then enter an agreement, find the right project or loan for you, wire the funds directly to closing. We don't handle any of your cash. Then you collect monthly payments from month 1. We then own the back end of the payments. As that previous slide showed, you get paid in full first before we make anything on that back end payment. You get your full capital and principal back, and then we start collecting those back end payments. If the property were to sell or refinance, we would all get paid our entire capital back, have made some interest, and have the ability to go and do it again. So you might be thinking, well, Kevin, I don't know anything about notes, which is why we outsource so much of the important stuff. We have a property preservation company that would collect payments, pay taxes and insurance, and make any collection calls on behalf of the borrowers. Those are also the roles of our servicing company who collects payments on our behalf, make sure we're within the laws and regulations, and all the accounting is handled properly. We buy and create performing notes and partial loans. We create cash flow with no headaches, tremendous opportunity in inventory. We set the terms in a win-win fashion for the deal and our investors' goals. And we seller finance, which is gaining popularity and having a greater need as lending is tighter and tighter. We leverage American markets, and we outsource 99% of the work as a landlord or as your own bank. The need for seller financing continues to be a high one, and we're at the front line of that business and continuing to grow. So some of our core policies to ensure smart and ethical lending includes one investor, one loan, one property. What that means is we do not pool funds. You will not be buying into a fund that's going and doing multiple deals. You're secured by your own investment and asset. The money is secured by the real estate itself. Funds are sent to closing via wire or certified bank check. A third party handles all funds and all closing. We do not touch your funds. All servicing is handled by a third-party servicing company licensed in the state. And we cut out the banks, which gives us more money. All of us. So to become the bank, you can purchase one of our performing notes. The advantage is that we remove all hassle and risk that comes along with being a landlord. The disadvantage is there's a slightly smaller return versus some real estate and a set number of payments. If the loan pays off early or refinances, we all get an instant payday and can repeat the process. To become the bank, you own the front end of the payments and begin to earn a monthly check on month 1. Your note is serviced by a professional and licensed servicer. If the loan pays through to completion, you get your expected return, and then we take over the payments on the back half. If the property sells or refinances, again, we all get paid our full capital, a good return, and repeat the process. Leverage your IRA. Any of these investments can be done with your IRA or 401k. Let your IRA earn a return greater than what your maximum contributions allow, legally. What do I mean by that? Well, your IRA can make an investment in a performing note. If that note sells or refinances in a couple months, you'll have a huge payday far greater than what your normal contribution could be. However, that's legal within all rules and guidelines. Please contact us to learn more and talk in more detail. So the investment opportunity available today is the partial note.